In this video, we'll take a look at constructing financial statements. This video is part one of a multi-part series in which we'll take a look at Mountain Catering, a fictitious company through which we'll take a look at balance sheets, income statements, cash flow statements, and the statement of stakeholders' equity, sometimes referred to as shareholder equity. We'll look at the creation of these statements and how they work together, and how through a series of transactions or some initial conditions or transactional information, you'll be able to prepare such statements for your business or businesses you might choose to work with. This series of videos on constructing financial statements is designed to assist you in completing the constructing financial statement assignments that go along with each of these particular videos. These run parallel to the remainder of the course that Professor Harrison is walking you through. The series is designed to follow Rocky Mountain Catering through its initial startup phase, through its first year of operation, and then consider the initial balance sheet, the first year income statement, the year-end balance sheet at the end of that first year, the cash flow statement, and the statement of stakeholder equity. There will be assignments that move along with each of these videos, and they're designed to prepare you to not only complete the review problem at the end of the course, but to help you better understand the construction of the types of financial statements that firms use. We'll start by taking a look at the balance sheet for Rocky Mountain Catering. Through the balance sheet, we have the opportunity to view what the company owns, as opposed to what the company owes, and the equity or net of those available to the company's equity stakeholders. We also get to see the beginnings of an equation that we'll come back to numerous times, and that equation is assets are equal to liabilities plus owner's equity. We see assets on the left-hand side of the balance sheet, and you can see here that we see liabilities, both current liabilities and long-term debt, and owner's equity on the right-hand side of the balance sheet. We'll also take a look at the income statement. And while the balance sheet is a statement of the company's assets, liabilities, and equity at a single point in time, typically year-end, the income statement is a statement that shows the transactions that have come through the company's operations during the year. So a balance sheet is a glimpse of at a moment in time, whereas the income statement shows us what's taken place over a period of time. As the balance sheet looks typically at year-end or maybe the end of a quarter, the income statement looks at the full year or perhaps what happened during the quarter. Together, the balance sheet and the income statement create the cash flow statement. And we'll look at the different elements of the cash flow statement where we see that cash is either provided by operations, provided by investments, or provided by financing activities. And sometimes it's not provided by these, but it's used by them. And then finally, we'll take a look at the statement of stakeholders' equity, sometimes referred to as the statement of shareholder equity. So first, let's take a look at Rocky Mountain Catering. Rocky Mountain Catering was founded by Jessica and Sean, two experienced barbecue pit masters who also love Dutch oven cooking and love to make artisanal sourdough breads. They've cooked for family and friends for many years. They're the most popular. Everybody goes to their homes when it's time for a barbecue. And they've decided now to turn their love of what they do for their family and friends into a business. They're leaving their full-time jobs. They're taking $50,000 out of their savings. They've received a small business loan for $100,000, offered 10%. They already have a number of small catering contracts with family, friends, and former business associates. And they're hoping to leverage these, along with some great reviews on social media, to generate enough activity and enough cash flow to have a successful first year. So from that information alone, let's consider the balance sheet. Again, we have to remember the balance sheet equation, where assets are equal to liabilities and owner's equity. We see assets on the left-hand side of the balance sheet, and we see liabilities, both current liabilities and long-term debt, on the right-hand side. And the difference between those is the company's owner's equity. Remember our equation where assets equals liability plus owner's equity. We can rewrite that in a form that might be more familiar to you, where assets minus liabilities equals owner's equity. Maybe we can think about ownership of a home, where a home has a market value. Most people that have homes will have a mortgage against it. Well, the market value of the home minus the amount owing in the mortgage equals the equity in the home. Well, that's the same as this second equation, assets minus liabilities equals owner's equity. Notice that on the balance sheet, we have assets represented in multiple categories, with current assets, or anything the company is expected to own for a year or less. And then we add various fixed assets, or those items that the company uses in order to create revenues and profits. Fixed assets may be divided into different categories itself, fixed operating assets and non-operating assets. In the case of Rocky Mountain Catering, we'll only look at fixed assets or fixed operating assets, if you will. Notice that we have dollar values for the smoker at $20,000, and we're looking at the initial condition column here for a moment. The smoker or the big barbecue for $20,000, for some ovens or refrigerators at $15,000, for a van at $20,000, and some kitchen equipment at $5,000. These are the initial costs of those pieces of equipment. After a period of time, we begin to depreciate those. And as you know, depreciation is where we recognize depletion in value because of wear and tear, obsolescence, and such on the asset. The dollar cost, what we paid for those assets, minus any accumulated depreciation, becomes the total net fixed asset. We're focused here on the initial condition for the company as we go through the next few minutes. But you can also take a look here at the 2021 results, where we acquired a little bit more in the way of barbecues and smokers. We went from having spent $20,000 to $28,000. We bought some additional ovens and refrigerators. We went from $15,000 to $35,000, but the van and the kitchen equipment were just left as they were. So we went from having a $60,000 cost basis in those assets to $88,000 is what they cost us. But now a year has gone by from this initial condition period, and we're going to take some depreciation on these, and we'll take depreciation of $7,500. There's a number of ways you can calculate depreciation, and we'll consider that when we look at the income statement. But we end up with a net fixed assets of $88,000 minus $7,500, or a total of $80,500. Current liabilities are those items that the company owes and must pay over the next year. Well, in the company's initial condition, nothing had happened yet, so there is nothing that's owing. But by the end of the first year, you see that we've developed an accounts payable balance, and an account payable or wages payable or accrued liabilities would all be examples of current liabilities. These are amounts that the company owes and is expected to pay in less than a year, and in fact, in most cases, much less than a year. Another liability form is long-term debt. Sometimes these are called long-term liabilities. We often will separate debt from liabilities, where debt is an amount owing, a liability if you will, but there's an interest rate associated with it, where a current liability probably doesn't have an interest rate. Long-term debt, separate from current liabilities, is likely to exist for well over a year. And that's the dividing point between current liabilities and long-term debt or long-term liabilities. Current liabilities are expected to be in place for less than a year. Long-term debt or long-term liabilities are expected to be owed for a year or more. And if you take a look, we end up with $150,000 of total assets in our initial condition, but we only end up with $100,000 in the sum of the current liabilities, which were zero, and our long-term debt at the initial condition. Well, the $150,000 of assets minus the $100,000 we owe is the company's owner's equity in this initial point in time. Again, as we explore the balance sheet, we're looking now at fixed assets. And the fixed assets will be the cost of any property, plant, and equipment that we use for the business's operations. And we carry them on the balance sheet at a net basis. By that I mean we place them on the balance sheet for the dollar amount that they cost us, and we then subtract any accumulated depreciation to get to a net fixed asset. Again, we're looking at the initial condition here at first, but let's take a look at what happened in 2021 to better understand this. In 2021, it appears as though we acquired some additional equipment in the way of some smokers and barbecues to the tune of about an additional $8,000. We went from $20,000 to $28,000. We acquired $20,000 more in the way of ovens and refrigerators, going from $15,000 cost basis to $35,000. We didn't do anything with the van. The van is still the van at a cost of $20,000, and kitchen equipment is still kitchen equipment at a cost of $5,000. There were no additions to either of those. So where we have an initial starting condition at the end of 2020, or perhaps the very beginning of 2021, where the company had spent $60,000 on its fixed assets, in this initial point in time, there was no time for there to be depreciation of these assets. So there's no accumulated depreciation. Our cost basis was $60,000, and the total net fixed assets were also $60,000. But by the time we end up at the end of that first year, where we have now $88,000 in our cost basis of fixed assets, we're going to depreciate those fixed assets over some period of time. We'll take a look at this a little more closely when we take a look at the income statement. But in this case, we're going to recognize $7,500 of depreciation, such that when we take the $88,000 of gross fixed assets, what we paid for the fixed assets, and subtract the depreciation amount, we end up with $80,500 in net fixed assets. Well, as I said, current liabilities are going to be equal to accounts payable, other current liabilities, and accrued liabilities, or items that we expect to have to pay within a year's time. Long-term debt, sometimes referred to as long-term liabilities, will equal any bank loans that we have outstanding, maybe a small business loan, mortgages, general purpose bonds, and a bond is just another word for a debt or a loan. It just happens to have a particular form. And long-term liabilities, so the total of our liabilities, will be equal to the current liabilities and the long-term debt. So as we look at the initial condition, we have no current liabilities. We have $100,000 in long-term debt, so we would say that we have $100,000 in liability. Paid-in capital is part of the owner's equity part of the balance sheet. And here we reference this as paid-in equity capital. On this balance sheet, it can be shown as founder's equity or founder's stock or paid-in capital for that common stock. The amount of money paid in by equity investors, founders, anyone buying stock from the company, plus any accumulated retained earnings or earnings that the company's retained for reinvestment in itself, become the owner's equity. So now let's return to Rocky Mountain Catering and look at the transactions or initial conditions leading to the initial balance sheet that we'll create for the company. Recall that Jessica and Sean have decided to use $50,000 from savings to invest in their new business, and they've gotten a small business loan for $100,000. They're using $40,000 of these funds to purchase a number of pieces of equipment. A large barbecue trailer like the one we can see here for $20,000, commercial ovens and refrigerators for $15,000, and some Dutch ovens and initial kitchen equipment or miscellaneous kitchen equipment for another $5,000. In addition, they've spent $20,000 on a used van to help them make deliveries. So how do these show up on the balance sheet? Well, let's start with the money that they raised. Notice that we put the $50,000 down here as owner's equity. So this is money contributed to the company representing these new owners, these founders' equity stake in the company. This is what cements the company as being theirs. We've then included the $100,000 business loan under the long-term debt part of the balance sheet. It's going to be added into total liabilities. This is now money that the company will owe to the bank or whomever they've borrowed the small business loan from. And those two items together give us a total liability and owner's equity of $150,000. So that's the right-hand side of our balance sheet. So now let's take a look at the left-hand side of the balance sheet. We're going to remember that they spent $20,000 on a van, and that they spent another $40,000, $20,000 for barbecues, $15,000 for ovens and refrigerators, $5,000 for some kitchen equipment, and the total then is $60,000 that they have spent of the $150,000 that they've raised. This leaves them then with $90,000 in cash, and the sum of those items is $150,000. So we see that the balance sheet balances because the $150,000 on the left-hand side is equal to the $150,000 on the right-hand side. Now that we've gone through and followed Jessica and Sean as they've created Rocky Mountain Catering and looked at the initial conditions that they created in, we're prepared to go ahead and complete the Rocky Mountain Catering initial balance sheet. Not only does this assignment assist you in reinforcing some of the things that you're taught in the course, but it helps you better understand the kinds of transactions and the kinds of conditions that lead to that initial balance sheet. This will also assist you in completing the review problem at the very end of the course. My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.